Welcome everyone to Tax Power Hour. Today is January 3rd, 2018, and this is the monthly webinar for January 2018. Today's episode, tax updates for 2018. We'll be talking about some of the current facts, the current state of tax preparation on early 2018 for 2017 tax year. That's the boring stuff, but we'll talk about that briefly, and then we'll bring in Jody, who I met Jody in person in November in a conference called The Art of Value, which was actually amazing to meet a person that's as enthusiastic or more as I am about taxes. And she posted in social media a stack of like 1,000 pages on December 20-something saying, okay, now to study the tax law. And I was like, is she serious? Is she gonna spend the holiday season reading tax law? And then I emailed her and I said, why don't you join me for January 3rd and to talk about the 2018 tax reform? And she said, no way, I'm not going to be ready by then. And then like a couple of days later, I guess she had studied and read it. She's like, okay, you know what, I'm pumped up, let's do this. And I thought it was great because then I didn't have to study it in depth. So Jody, thank you very much for that. And I'll introduce her formally a little bit later on. So we'll spend about 5 minutes talking about Tax Power Hour and other recommended events that I'm involved with. We'll spend no more than 10 minutes talking about a summary of 2017, just some minor changes, mostly inflation adjusted tax brackets, and then some important notes, especially for tax preparers or even taxpayers walking into work with a tax preparer, so you have good facts and good information to go straight to the point instead of the tax preparer having to explain, which I think is going to be a long tax season because we're going to have to explain a lot of things to a lot of folks this season. So we'll definitely like to thank the government for giving us accountants a lot of work this year. Maybe I'll vote Republican next year. Who knows? Maybe not. Okay. So we'll spend no more than 10 minutes on that. Then about 40 minutes, Jody will present all the 2018 tax reform, not the whole thing, but I think the highlights for small business owners and the stuff that really matters to the most individuals. There's a couple of obscure things in the tax law that doesn't affect a whole bunch of folks, but she probably won't go into too much detail about that, and then we'll open it for Q&A. So what is Tax Power Hour? It's a small business and self-employed tax tips and tricks webinar. It's a monthly series. Once you're registered, you will get the monthly notifications. We will go in a little bit of a break during the heavy tax seasons like March and April, and where we like to continue the conversation about tax, the fascinating world of tax. It's in our Facebook group. So just search Tax Power Hour on Facebook, join the group, and this is where we would like to have discussions and other tax practitioners and small business owners to discuss, important topics of tax. And I believe this year our group is going to blow up because there's going to be a lot of questions, especially with the reform. So every first Wednesday of every month, 30 to 60 minutes. We'll be on break until May after the February episode. We may have a special episode that's with sponsored content. We're trying to get QuickBooks into it. I'm giving them some free love to sponsor the webinar and for some of the tax software, which would make sense. So we'll see if that happens. We may get a surprise one pretty soon. We don't do CPEs on this particular webinar. Other webinars that I do CPEs. This one is not CPE because this is not targeted for tax practitioners. This is targeted for non-practitioners, QuickBooks consultants, and small business owners. Now, by myself, I'm Hector Garcia. I have an accounting technology / tax planning / management consulting firm in Miami. My email is hector@garciacpa.com. If you have any questions about QuickBooks or accounting or tax, I'm usually pretty open. Today's guest, Jody, she's a CEO of New Vision CPA Group based out of Mount Prospect, Illinois, but she works with clients all over the country, and she says she also has some international clients as well. Her Twitter handle is Jody Padar CPA, just her name and the word CPA, and she was voted top 100 most influential people in the accounting professional for 7 years in a row, 2011 to 2017. And I didn't mention that she's also an author, right? She has a book called The Radical CPA. She didn't put it in her profile, but I wanted to mention that. And her website is newvisioncpagroup.com. She will come in a little bit later on. Real quick, so some disclaimers. This webinar is not legal advice. This is not tax advice. These are hypothetical situations where two tax practitioners contemplate and think and opine about tax law. If you actually want to take action on your tax return and your tax planning, consult and hire a professional tax preparer that will look at your situation. These are all hypothetical situations. None of this is legal advice. Although we are trying to interpret from actual tax law, none of this is legal advice. Hire a CPA, hire an enrolled agent for that. So let's get on started. For the 2017 tax year, nothing from the 2018 tax reform should affect anyone's 2017 tax returns. Now, President Trump announced, I don't know, last month somewhere, that around February, employees will start seeing bigger paychecks or lesser withholding on their paychecks. The big question that I have, a technical question as a CPA, is since I've been looking at tax tables for 12 years and I've been doing tax returns, and they're all based on the number of exemptions, which has to do with, you know, how many dependents you have yourself and your spouse. Since that's no longer a factor, I really don't know what these tax tables are going to look like. So we actually don't know exactly what these tax tables will look like. And there's also a new factor, which is the standard deductions. So how would that come into play? So we actually don't know about this. I assume the new W-4s are not going to ask for number of exceptions. W-4 is that form that employees use to say, hey, I got, you know, so many exemptions. Maybe it's just married, single, and that's it, and they'll base it on that. So because that's a big unknown, employers are instructed to use 2017 tax withholding table. So we're using the old table to do withholding until mid-February at some point where the IRS actually comes out with the new procedure for withholding. So that's an important thing for employers, because I had a couple of clients freaking out saying, hey, I have an employee asking me, you know, is my paycheck going to be bigger this year? You know, and that's a legitimate question that tax advisors or, you know, accounting practitioners like myself are getting from clients, and I don't have an answer. You know, the answer is, you know, for now, tell them no. Maybe, but President Trump, you know, like, you know, thank you, President Trump, for making my job really hard this year. But again, you know, if you got good clients and they pay good fees, I think it's actually kind of a good thing. So I think depending on what side of the political aisle, you could choose to see it like it's a good thing or a bad thing as a practitioner. So for 2017, the only true changes that we're going to see is those standard inflation adjustments, you know, where the highest tax bracket was at 466 for married filing jointly, and now it's at 470. So other than changes in tax brackets, and the only reason I'm putting them on the screen is for the YouTube video recording for folks that want to print it or download the slides, is the only new exciting thing I can tell you about 2017 tax year. Same thing with single tax brackets. It's just small inflation adjustment, which is typically a 1% increase of the levels that go in the tax bracket. So from 2016 to 2017, no one really should see anything different on their tax returns. Let's talk about the deadlines now, because there was a big change last year, and so folks are still adjusting to the big change, which is the swap between the pass-through entities and the corporations. We'll talk about that briefly. So specifically for folks that are watching this, are small business owners, not necessarily tax practitioners, January 16th will be the last day to make your estimated taxes for last year. Okay, even though the taxes are due for most individuals on April 17th this year, because that lands on a weekend. The April 17th, you can still pay your whole tax bill on April 17th, but there's a small penalty that has to do with not making those estimated payments. So I would say that at least by January 16th, so that's only a few weeks from now, make your last payment for 2017, so you get the least amount of estimated fees for not making estimated payments. By January 31st, you must file your W-2s, your quarter 4 941s, this is for employers. You must file your 940s, also for employers, and your 1099 forms are due January 31st, whether they're paper filed or e-filed. There's no more extension to February or March for electronic filers of 1099 miscellaneous forms for contractors. There's some exceptions for other 1099 forms that has to do with not subcontractors but other things, but for the most part, January 31st is going to be a huge deadline. Now, for folks in Texas and Florida and their clients that have been procrastinating for the 2016 tax returns, there's also another extension for 2016 tax returns to file your 2016 returns by January 31st. And I got about 16, 17 clients I haven't filed yet, so my January is going to be a lot of work. So that's only for the folks that have to do with Irma and what was the other hurricane? Harvey. And I assume Puerto Rico as well, but I don't know what the Puerto Rico deadlines are. Now, for S Corps and partnerships is March 15th. This was a big change from last year where partnerships used to be, the deadline for partnerships used to be April 15th. They were moved now to March 16th, and they swapped with corporations. Corporations are now due at the same time as individual tax returns, which, by the way, I like to give credit to the IRS. This makes a lot of sense. You know, you do all the non-tax paying entities and pass-throughs by March 15 to allow the tax preparers to have all those K1s and stuff to then prepare their personal returns. It's actually really, really important swap that they did. But some folks are still confused about the March 16th and April 16th deadline for partnerships and corporations. They just swapped spaces pretty much. And for folks that are doing extensions, the extension for partnerships and S Corps is going to be on September 17. Again, September 16th lands on a weekend or landed on a weekend. So it's September 17. And for corporations and personal extensions, it makes sense 6 months later. It's going to be October 15th. Go ahead and watch the YouTube video I have on the link below that talks about all the penalties and the process of paying your tax returns late. Just because most folks, including some of my clients, I explain it every single year that you will get a penalty for paying stuff past April 15th, even if you're on extension. So in that video, I kind of break down how all the IRS penalties work based on filing late, paying late, not making prepayments, estimated payments, and all that stuff. So refer to that YouTube video for that. Now on to the 2018 tax reform, which is actually not tax reform at all, in my opinion. I mean, I would say for corporations going from 35% to 21%, maybe you want to call that reform, but then nothing on the tax law was reform. I mean, it was 1,000 pages of addendums to the current law. True tax reform would have been scrap it and do it again. So I don't know who's bragging about reform. Now, they call this the Tax Cut and Jobs Act. Okay, this is a marketing word, obviously, right? They're making it sound like it's all about tax cuts and jobs. And I know Jody will have her opinion about it. I'll give you my opinion on this as well. Please don't call this the Trump tax plan. Please don't call this the Republican tax plan. Please don't call this the GOP tax plan. Or don't call it 2018 tax reform. It doesn't deserve any of those names. You call it the Tax Cuts and Jobs Act because that's really what its real name is. Anyway, let's talk about some of the major shifts. The biggest change, I would say the biggest transformative change, because it does existentially change how taxes are calculated, has been the brackets. The brackets, instead of being 10, 15, 25, 28, 33, 35, and 39, have been changed to 10, 12, 22, 24, 32, 35, and 37. What the politicians will brag about is the almost 3% difference on the top end, because that's really the easiest way to explain tax reform is to explain the top tax bracket and how it goes down, and is the one that has pretty much about the biggest change. So the top tax bracket went down 2.6%, and the second to the bottom tax bracket went down 3%. Now, some of the also major changes you can see is how the dollar amounts have changed as well. So, for example, last year you made, if you were single and you made $418,000, you were at the top tax bracket. Now you have to make $500,000 or more. So it's not just a lowering of tax bracket by 2 to 3%. It's also changing the income levels that hit that tax bracket. So it may not just be that straight 2 to 3% reduction for you, depending on what bracket you are. You could also be completely shifted to a lower tax bracket. Now, on the middle tax brackets, there isn't that big of a dramatic shift. You know, like there's even I would say I think for the most folks that make between $100,000 to $150,000, I think this tax law is not going to do mostly nothing, pretty much. You know, which is the middle class, which is kind of weird. But the other existential change, and again, Jody will go into more detail, has been the removal of personal exemptions. So before, for yourself, your spouse, and every dependent, which was a kid, I mean, there's so many types of dependents, but it could be a a kid, it could be a parent, it could be some other sort of dependent. For every single dependent that was on your tax return, you get an automatic reduction straight from the top of your income of $4,000. That has been completely eliminated. But the standard deductions, so folks that don't itemize, folks that don't really get into detail about what's deductible and what's not, they just take the maximum, freely allowed deduction by the government. That deduction has been doubled. Now, that doesn't necessarily mean it's tit for tat. Like if you used to have, 9 kids, and I don't know how many of you are out there, but if you have 9 kids, you had to, the first $36,000 that you made plus you and your spouse was completely tax-free because of the exemptions. Now that's not true anymore. Now they replaced it with a tax credit, and I'll allow Jody to talk about that, but they doubled the tax credit. But that's the biggest existential change. What this also means, or it could mean, that a lot of tax preparers that were doing a lot of itemized deductions, and they were making a living with those itemized deductions, but they don't quite get to the doubling of the standard deduction, they may not be needed anymore. So I think that some of the higher end tax professionals will definitely have a lot of work, but some of the run-of-the-mill guys that used to, or guys or gals that used to do a lot in itemized deductions, possibly won't. Especially those I don't want to knock H&R Block or anything, because they're an amazing company from a growth perspective, but that's about it. But some of used to have, like mileage for unreimbursed expenses, that's not gonna be here anymore. So that has, I think the itemized deduction and standard has been the biggest change. On married filing jointly, there's an important thing to note, and Jody, I'll ask you in your part if you actually noticed this. Normally, when you go from single to married filing jointly, so when you actually do that doubling, the brackets actually double. And if you notice, for example, on the final plan on the right side, we have $38,000 is the limit for that second tax bracket. If we go to the married filing jointly, is $77,000. That looks like a doubling. But if you look at the most bottom tax bracket, which is $500,000 or more, sorry, at the highest and the bottom of the list, notice that it doesn't double. So there is kind of a weird penalty on the folks that make $400,000 and more that are married filing jointly. There's a weird, strange sort of penalty on married filing jointly. There could potentially now be a situation where two folks that could be single or married, let's say they're thinking about getting married this year, and they're asking you for tax advice, and they're saying, should we get married to get a tax break? Let's just say that's the case. And each of them makes $300,000 or $400,000. It's possible that it's much better for them to file single for the first time in 35 years. Married filing single could actually be better than married filing jointly, which historically was never the case. Jody, did you pick up on that sort of weird penalty for married filing jointly?
I did, but I think it's interesting because so many other things are changing that I don't think you can just look at it by itself, right? So I think that's the big thing, right?
Yeah, I'm not criticizing it in an isolated way. I'm not saying that there's something wrong with it because of it. I'm just saying that it's quite interesting to see that all the tax brackets double from single to married filing jointly, with the exception of the 35 and above, which doesn't double. So I think again, I've married some folks, in November or December, where people are telling me, hey, should we get married now or in January? And we've done the tax example, and it actually made sense tax-wise for them to get married, before the end of the year and the next year. So I've actually married some folks, and I've actually had some folks have kids in a year because of the tax. I don't want to get into that, but just on the advice portion, I wasn't involved in the other piece. But yeah, so that could also be the case this year because there has been a significant change on that tax credit. So I'm going to go through the summary, and this is just quick highlights before after this, I'm going to give it to Jody. So some of the important highlights about the change, which I think these are the talking points that if you're in a party and you're an accountant, somebody says, tell me about tax reform, and you want to do it in 5 minutes, just go through these 10 bullet points, and you've covered everything. So 1, tax brackets have been changed between 2 and 3% for most folks. The personal exemptions has not just been reduced, has been sort of replaced with double standard deduction plus child tax credit. Okay, if you used to have a lot of dependents that were adults, non-child, that will not be a benefit for you. But if most of your dependents were child, then it will be a benefit for you because the child tax credit doubled. There's no changes to earned income credit, which I just do my quick politic rant. If I was a Republican and I wanted to stick it to Democrats, I would have gotten rid of earned income credit. But I don't understand why they kept earned income credit. This basically means that the same 45 to 47% of Americans that pay no taxes will be in the exact same position. So we're not getting any more Americans to pay taxes with this tax plan. I think we're just moving around for the ones that already pay tax. Okay. Now there's a limit to the state and local taxes that it has been limited to $10,000. That means that the folks that pay a state tax, which in Florida we're fortunate not to, so it's not my problem. But the folks that pay that, especially on high taxable states like New York or California or Illinois, and I don't know which other ones to mention, but those typically would get a deduction for paying that state tax. That's now going to be limited to $10,000. So the first version of this bill was going to repeal it completely, and I guess through the reconciliation they kept it at $10,000. So for the folks that historically itemize that are on high income tax states, this tax law could hit them a little bit harder. Now, was this a politic move to stick it to the blue states? Maybe, right? I mean, there are some red states that have high income tax. I think Iowa is one of them, and Pennsylvania, which voted red, also has pretty high. So I don't think it's just a politic thing. It's just what they decided to do. Now, for some reason, they rolled back medical expense deduction from the 10% floor that happened during the Obamacare sort of tax change, or during the Obama era, that increased from 7.5 to 10. They rolled it back to 7.5. This is the minimum amount that you have to spend in medical expenses before it becomes deductible. Mortgage interest, which is not going to affect a lot of folks, has been reduced from $1 million mortgages to maximum $750,000 mortgages. I think there's going to be a very small group of people that will be affected by this. Maybe in some of the blue states where real estate is over $750,000, you could see it. So maybe that was part of the logic, not sure. Now, home equity line, which used to be tax deductible up to $100,000 in debt, no longer deductible. Now, I believe that starts next year. So any mortgages acquired next year, not the old stuff, will be grandfathered. Charitable deduction used to be limited to 50% of your AGI. That has been raised to 60% of AGI. Again, I'm not sure how many more folks that already give half of their salary to charity want to give the extra 10%, and it may affect them, but there may be some that will. Now, there's been a removal of the miscellaneous deductions on the itemized deductions. There's been a removal of the general personal casualty theft losses, which is actually very small subsection of the population that takes it. There will still be federal disaster areas as an exception. Alimony deduction, which is huge, that has been removed, and that's also, I think, divorce decrees that happened after December 31st of this year. So any divorce settlements that happen this year, alimony will still be deductible. So only new divorces. And just so you know, the person that pays alimony used to deduct the alimony, and the person that receives the alimony pays taxes on the alimony. That has been fundamentally changed. Don't know where the logic on that is, but that's what it is. Moving expenses, if you move 50 miles away for a new job, you used to be able to deduct that. That has been removed with the exception of military, of course. State tax has been doubled. So if you die and leave your state to your family, now you have double that. So it went from 5-point-something million to 11-point-something million, small subsection of the population. However, for some tax practitioners like us that deal with small business owners that have been growing for 5-10 years, some of them are building states of 5 million, 6 million, 7 million, and this actually becomes a big deal to some of the folks that I'm dealing with and Jody is dealing with. AMT on the individual side, this alternative minimum tax has not been repealed on the individual side. but the limits have been increased. I don't want to get into that. AMT just kind of makes my head hurt. But on the corporate side has been repealed. And this is the biggest one, biggest one. There has been a repeal of the health insurance mandate, but it's as of next year. So this year you still have to have your minimum health insurance, otherwise you will get that big penalty. So I assume I'm gonna get a lot of my customers saying, I don't have insurance anymore because Trump, fixed it. Trump didn't fix it for 2018, and Trump wasn't involved. He just signed it at the end. This was all Congress. But the repeal happened it happens as of January 1st, 2019. I believe that's going to be the biggest misconception that a lot of folks are going to have, thinking that this year they don't have to have health insurance. They do. On the business side, quickly, because Jody will cover most of this stuff, corporate tax has been changed to 21%. It's a flat tax. That means that small subsection of corporations that have between $0 and $50,000 in income tax are actually getting an increase from 15% to 21%. You still have the double taxation dilemma that all C Corp owners have, right? That you pay taxes on the corp, pay taxes on the dividend. AMT has been eliminated for corporations. That is big to make tax preparation easier, and also big for some folks that have accumulated losses. I don't know if the losses are from the past, if the AMT would kick in or not. I'm not sure how the law, I don't think it's spelled out yet. I'll ask Jody to comment on that. If she knows if you got accumulated losses from before, will the AMT kick in to disallow some of those losses? And for S Corps, partnerships, and self-employed individuals, including Schedule C filers, there will be a 20% deduction on qualified business income, but there's going to be an additional limitation for service businesses, which includes accountants. But until the IRS codifies it, I'm not qualified to tell you which businesses are or are not in this specific limitation of that 20%. But that right there is the mother of all deductions for small business tax planning. That new 20% deduction of the pass-through entities, plus the change in corporate. I suspect that this year there'll be a lot of folks with two corporations, and they'll be separating their businesses in two groups and be able to do some tax planning on the service stuff, non-service stuff with corps and S corps. So that should be interesting. Anyway, I'm going to skip that slide. I'm going to pass that on to Jody, and I'm going to shut up and let her speak for the next 30 minutes. Jody, thank you for coming in. The floor is yours.
Thanks, Hector. So, boy, he gave us a really good overview of a lot of the individual changes. And I'm going to go pretty quickly through a lot of my beginning slides because I think Hector did a phenomenal job of covering this stuff. The interesting thing to me is that Trump said on Friday, whether you love Trump or hate Trump, I don't really care, but he said that he knows taxes better than the greatest CPA. So for us CPAs, you got to love that. A little bit about my background is I actually have a master's in taxation, which means that I have 10 additional master's classes specifically in taxation. So when it comes to the code, I know it pretty well, and I actually enjoy it. So when Hector invited me to be on the show today, I was pretty excited to do it, especially because if you see that graphic there, that is my personal tax code. Well, that is the new tax law, right? It's about 1,000 pages, and you can see how dog-eared it is and how much I enjoyed reading it and understanding how it was changed. So it's pretty cool. The thing that I want to point out is if anyone tells you they know what's happening exactly in regards to this new tax law, don't listen to them, because realistically, we still really don't know what's happening with the tax law, because once Congress makes the tax law, the IRS actually has to make the rules to enforce it, and then it'll get litigated. So then as taxpayers go through and take deductions or don't take deductions, the U.S. court system will then actually make an impact on the tax law, and things will change. So this has been a lot of changes that have happened to the tax law, but just know that anyone who's telling you exactly what they know and what they don't know, there's still so much unknown out there that don't believe them, and be wary of that person. You want to connect with tax professionals who realize that the laws is still continuing evolving, and it'll probably take us 3 to 5 years to really understand it. So with that, we'll move forward to the next slide. So Hector, why don't you go ahead and advance me up? So if we look at individual taxes, with which Hector went through pretty well, is that it sets the rates significantly lower. So, I think this is important to understand. And I think the big thing about individual taxes are they're going to change, but I think overall, most people will be in a better spot. And I've used a couple of the calculators that are out there, and just on a couple test examples, and most people have seen savings in their taxes overall. So I think from that perspective, most people will be in a better spot, which I think is a good thing. And then some people won't, but it'll be interesting to see how it all flushes out. So you can hit the next slide. The standard deduction is going to be significantly increased, and the tax credits that go along with it are going to be increased. So even though you may have itemized last year, and a lot of in Illinois, because we are a high tax state, a lot of people were freaking out. Should they pay the real estate taxes early? And they were really making themselves crazy about it. And what I found is it was, from my perspective, it was really the state of Illinois trying to get their real estate tax money early. But in actuality, a lot of people weren't affected by it anyways, because the increase in the standard deduction makes what they thought an itemized deduction tax return moot. So when we actually ran the numbers on a lot of our customers, it either they hit AMT and it wasn't valued, it didn't matter, or it didn't put them high enough to make the new standard deduction affected. So don't believe the media. I mean, ultimately, that's the big key point. Don't believe the media. Connect with a trusted tax professional who can actually help you make sense of it. And I think the important thing is to realize that so much stuff changed that it's just going to be different. It may not be better or worse. It's just going to be different. And if you can accept that, I think you'll go into this new year with a lot less stress, because I think the media is stressing everybody out about how the tax effects are gonna the tax changes are gonna affect them.
And a quick comment on the media. I think I've read and studied enough of this on both kind of like center left wing type of websites and center right wing websites, and it looks like both positions, both can make an argument whether this is a good thing or a bad thing. I mean, both can twist and change scenarios in a way that they can make this sound like a horrible thing or make this sound like a great thing. So I would say study this on your own and understand it. Talk with your tax professional. Don't get too hung up on whether it was Trump himself that did it. If at the same time, right, if it was Hillary Clinton who would have done the reform, some other people would have found a way, or Bernie Sanders, a way to devilize it. So I'm actually excited that there's been a change, a shakeup in my profession. It kind of kicks me in the butt a little bit, but there are some good aspects and some negative aspects to it, and I think regardless of where you stand, you can make a case for both.
Well, and I think
I agree with that.
And I think the other thing is you have to look at each taxpayer's facts and circumstances specifically to see how it applies to them, because everyone makes all these generalizations. And if you have something very specific to your set of circumstances, you may make out by it, and someone else who has just one little thing different may not. So remember, it's generalizations, and the tax code is very specific to a person's individual facts and circumstances.
Right. And if you're not in the tax planning business, I think you should be. This is the best year ever. If there has been a year telling you that you should be in the tax planning business, is this year. Because finally, this is the year that making a significant change from the previous year can actually make significant tax changes by leaps and bounds. Previous years, we have very limitations of what we could do. This year, there's a lot of things. Have more children. so it needs to be born by December 31st, so that gives you more
You missed it.
tax credit.
Oh, so the interesting thing is they expanded the child tax credit, and I think this was a big deal because it went up significantly. The new limitation on it is like $400,000. It used to phase out over a little over 100,000, so that tax credit changed. And they did keep the child and dependent care credit. So, and they also did it for older dependents as well. So that's a good thing. You can switch the slide. They did preserve the mortgage interest deduction. They limited it, but they preserved it. So people who live in high cost of living states like me in Chicago, a lot of our taxpayers won't get the benefit of it, but the majority of America will. So I think that's a good thing. Next slide. They they allowed medical bills to stay, so medical expenses are still a valid expense. So again, for those of you that will itemize, and again, in order to itemize now, you have to have more than $24,000, which that eliminates a lot of the population. But if you will itemize, especially if you're paying for assisted living or additional care, the medical expense deduction is still there. Next slide. Charitable contributions are still there. We went through it in an earlier slide, so we can advance this slide as well. And the individual penalty tax is gone, but as Hector said, it's not this year, it starts next year. So that's the healthcare tax is gone. And the earned income credit is staying the same, so we can advance that slide, because Hector did such an awesome job. So this is a big one for me, and I really think this is a really important one. And this is 529 plan. So this is tax-free savings for your college education, or for if you want to send your kid to private school. So this changed because it used to be only for college students, but now you can actually use it for regular private schools. So I think this is big, and it's tax-free earnings. So if you're looking to save money for your kids' college or for private high school or even secondary or other schools, go ahead and open a 529 plan and get that tax-free earnings on it. Next slide. They didn't change the benefits for graduate students. So they kept those in the code. So basically, a lot of the if you were to receive a graduate funding, like a grant for education, those are still tax free, and that was a concern because people thought those were going to go away. So next slide.
Which includes corporations giving a benefit of $5,250 of annual benefit to their employees, so they can go to college tax free. So that's still in effect, and also getting up to $2,500 worth of your student loan interest reduced from your AGI, so a deduction that's also still there. So there really hasn't been any changes to the whole college benefit area. Correct, Jody?
Correct.
Nothing with the American, with the Hope credit or the American educational credit. None of the stuff has been changed from what I see.
Right, for the most part. Next slide. And then these were just the rates that Hector had gone over before. So, I mean, overall, the rates are going down. So I think, I mean, for me, that's a good thing. I'm happy to pay less tax. But I think the next piece is the business side, which I think, as Hector said before, this is huge, right? Because this is where we're going to have opportunities to really change things. And when I say business, I mean small business. So small business to me is 0 to 10 million. The government thinks it's up to 25 million, as you'll see how they change some of the rules. But this is big because entity choice is going to make a significant difference in your small business life. So if you own a business, you really need to consult with a professional about if you want to change your entity structure or not. So the corporate tax. So in the old days, it was taxed at 35%. With now the corporate tax rate is a flat 21%. That's huge, right? And so for many small businesses who were S corps, it might be an opportunity to be a C corp. So again, we're going to go through a little bit of entity structure later on, but I think it's something to think about is how are you taxed, and should you still be taxed the way you are currently? And next slide. The AMT, they corporate tax AMT was repealed, so that's a good thing again, and Hector touched on that. Um, so it's going to be easier to calculate those corporate taxes. I guess I say that in jest, but keep going. Next slide. Bonus depreciation. So this is big. So this means that anything that you purchase that you typically would have had to depreciate in the past, you're going to be allowed to expense 100% if you choose to. So this is a big deal because that means if you buy a piece of equipment, you can write it off in year one. So you may be able to significantly reduce your income level based on equipment purchases. So I think that's huge for small businesses. Now, we always had 179 deduction, which allowed us to write it off in full, but this allows you, the way bonus is different than 179 is in 179 you actually had to have a net income to write something off in full. Bonus depreciation allows you to write something in full off and still take a loss. So that's a huge thing, and for bigger corporations it's a big deal. The reason they put this in a tax bill is to stimulate the economy, because they want people to buy equipment, they want people to buy vehicles, they want people to buy stuff, which I think is pretty cool. So know that you have bonus, and the cool thing about bonus is you can elect it or elect out of it. So you can elect to depreciate certain assets and not to depreciate others.
Jody, have you read into, I haven't read too much deep into it, but and I actually made a blanket statement saying that nothing from the new tax laws will affect 2017. But I was reading something that they retroactively changed one piece of the 2017 tax law, which is to add 100% bonus depreciation for any assets that were bought from September 27 and on. Did you read into that at all? I didn't get too much into it, but I thought there was a change for 2017 bonus in the new tax law. Did you read into that at all?
I don't know off the top of my head what the specific is on it, but again, with all of these laws, all the specifics are so new that you just have to do your research and make sure that it applies the way it is.
Yeah, so I would just
Yeah.
keep that in mind, that possibly, I was reading that there was something going back retroactively when on the 100% bonus depreciation for assets bought on September 27 and above. But yeah, again, maybe ask your tax professional about that. I'm not qualified to tell you yes or no yet, but I remember reading something about that.
Next slide. So luxury auto. So this is because bonus depreciation has a limit on luxury automobiles. Now, a luxury automobile, I think, is any car purchased over $11,000, right? So we know what that kind of a luxury auto is, right? It's kind of funny, right? So the luxury auto is not really a luxury auto, but realistically, what that means is that vehicles that are used for like as the owner's automobile, where they have specific depreciation limits on them. And with the new rule with the luxury autos, you will now be able to take depreciation of $10,000 in the first year of if you buy a new car, right? So if you purchase a new vehicle in 2018, you can write off $10,000 in the first year. So that's pretty cool. And then it's 16 in the second year. And before it was limited to around 5 or 6,000 a year. So again, there's an opportunity to go buy a new car, and I'm sure all the dealerships will be advertising that as well. So, and this is, and so then next is the 179 deduction, which has been around forever, but they just changed the limits. So now you could 179 up to $1 million, and they changed the limits on it. But again, it's the ability to expense more and to come to a I'll say even before you put that 22% tax or 21% tax on it, you can significantly decrease the amount of income that is subject to that tax. And that's what a lot of people don't understand, is that when you are able to write off all these things in year one, it's a timing issue, meaning you're going to get a greater deduction immediately, but that means you're going to pay less tax immediately. And so that's significant for small businesses, right? Because you can not only pay less tax, but you can reduce the amount that is taxed. Now, remember, depreciation and stuff is a timing issue. So in later years, you'll have to pay more, but it's pretty cool to be able to expense something in full immediately. Next slide.
If you don't mind, Jody, let me just interject real quick on something. So for the folks that are non-tax professionals, non-tax preparers, small business owners, let me just explain this real quick. Basic accounting rules say that if you buy an asset that will survive more than a year and is over a certain dollar amount, again, the safe harbor rules are $2,500 on the IRS. So that you don't take a deduction for that purchase, that you have to break down the deduction over the life of the asset. Section 179 allows you to sort of reverse that accounting concept and buy a very large property, I'm not going to say property, a very large asset that you can completely take as a deduction that year. I mean, real estate is never going to fall into this category, or has it? I mean,
it changed. So now you can actually, real estate itself won't, but a lot of the improvements to real estate now you can.
You can, right? So I mean, so generally speaking, anything that's real estate or was attached to real estate, it had to go to that 15-year period, or that entire real estate life period, which is 27 years or 39 years, whether it's personal or commercial. So with Section 179, they allow you to up to $2.5 million worth of assets, non-real estate, for you to expense completely that year. Now, 179 limits your deduction to your income. That means that it can only bring your income down to zero. Whereas the bonus depreciation, which you talked earlier, and I don't know what the dollar amount limitations on that is, but the bonus depreciation can actually bring your income to negative. So if you got one corporation that's giving you profits and one corporation that could potentially be zero with a 179, or it could be negative with 100% bonus, and you want to pay less taxes that year, you want to take bonus instead of Section 179. I don't want to get too much into the technicals of that because your tax preparer is supposed to know this stuff, but it's just giving you general knowledge so you know what to ask for or what to talk about with your tax preparer. Jody, talk about entertainment.
Okay, this is huge, and I think this is huge for small business owners, because traditionally we were allowed to deduct meals and entertainment expenses at 50%, and they took away entertainment. They just took it away. It's gone. So we're only allowed to deduct meals now at 50%, and you can no longer deduct those Bears tickets. If you take a client to a football game, guess what? Not deductible. Only, I guess, your beer in the stand, right? So so this is huge, because and why did they take it away? I think because it was ripe with fraud. I think a lot of people over deducted stuff. And so I think they said, look, we'll just put the kibosh on it and we're no longer allowing it. But I think a lot of small business owners are going to see this incrementally affect them. And I think it's actually going to affect a lot of sports teams, because a lot of the season ticket holders were corporations who would write off those tickets. So we'll see how that plays out. But next slide.
I'll talk about that law real quick, because that's kind of important. Before 2018, so 2017, you could deduct entertainment, but you had to be the one entertaining your customer. Like, had to be someone from the company, had to be with the client, because you had to entertain them. You couldn't give them Super Bowl tickets. That was never allowed. So they haven't taken that away. That was never allowed, period. What they took away is the capacity for you to entertain your client and take a deduction on it, no longer. So, but they kept the meals. They kept the meals. So if you want to entertain a client, take them to a place where you can eat and be entertained at the same time, but the entertainment portion itself would not. And all same rules apply on the meal side. You have to talk about business, you have to document it. All that stuff still comes into play. Travel meals, the same thing, right? Travel meals, right. 50% deductible unless they're like per diem reimbursements. So that hasn't changed at all. So I just wanted to kind of point that out, because entertainment was one of those confusing areas.
This is another big thing, cash method of accounting. So you now can stay in a cash basis of accounting till $25 million. So it used to phase out for C Corps around 5, and for S it didn't, but this is huge because it now means that you won't have to pay tax until you actually collect your money, not based on receivables, which is a big deal for small businesses because who wants to pay tax on money they had that hasn't walked in their door yet, right? So now what it will mean is you may keep a financial set of books and you may keep a tax set of books, right? You may actually want to use accrual basis for reporting purposes, but use a different set of books for tax purposes. So, but I think that the big thing is, and it gets a little bit more complex there, but the big thing is that was really a good thing for small businesses to change it to $25 million to remain on a cash basis. Next slide.
And if you don't mind, I want to make a quick contrast. So before 2018, your business had to sell more than $10 million in order for it to possibly automatically be shifted to accrual basis, or have an average of 5 million between the last 3 years. That would automatically shift you to accrual basis. So now you're talking about small businesses between 5 million and $25 million, which is a huge piece of the small business market, now can stay in cash basis pretty much permanently until they hit the 25 million, which really, really simplifies tax rules. And this is the one portion of the tax law that doesn't really give much love to accountants, because we love accrual basis and we probably make most of our money doing accrual basis type of adjustments. But hey, what can you do? We have to become advisors in other areas. The tax law doesn't help. So for the most part, up to this point, the tax law was great for us. Now, kind of making it easier for people to do their taxes. But that's cool. I like that. Go ahead, Jody. Sorry about that.
Next slide. So, and again, we'll skip through this slide because I want to keep it to an hour, Hector, and I know there's still some more stuff going. So do you want to get to the part where we get to the deduction?
Let's do that. So real quick, inventory, over $1 million in inventory before require you to do accrual basis accounting for inventory. Now you can do it potentially for 25 million, but I would tell you, let's wait until we get the actual codification of that, because $25 million worth of inventory in cash basis, I don't know how that's going to fly. I mean, that's just really so we got to figure that out, how that's going to fly. So interest deductions, we talked about that. Let's skip over to, which one did you want it to skip over to? Was it this one?
Entity choice, yeah. Go back one. Yeah. So just to briefly go over entities, so you can be a C Corp, an S Corp, a sole proprietor, and also a partnership. And basically what happens there is it just means that a C Corp is taxed as its own entity, right? S Corp, a partnership, or a sole proprietor are taxed on the individual tax returns, right? And so in the old days, corps would be taxed at up to 50%, and sole proprietors, S Corps or partners would be taxed at 40%, right? And now with the new rules, that's going to make the opportunity for tax planning and entity choice huge. So next slide.
Can you explain that 50%, 40%? I'm getting some questions saying, what do you mean by that?
So those were the old rates, and if you potentially had a double a dividend tax, a dividend would be taxed at the corporate and then taxed on the individual.
So
right?
So combine double tax, the double tax rate for a C Corp, and then I guess the combined self-employed tax on the pass-throughs.
Correct.
That's what you mean. Okay. All right.
Okay. And then next slide. But now they've created this new section 199A, and it's anything but simple. And basically, this is going to be huge for small business owners, and this is where they absolutely need to connect with a tax professional, because you're going to have wages, you're going to have to look at lesser than and greater than, you're going to have to look at phase in and phase outs, and then you're going to have to create a deduction connected to it. So this is really good for CPAs and accountants, not so good for small business owners. But if you can navigate the stuff, I think small business owners are going to be thrilled with the outcome. So
Yeah.
next.
Section 179 will be known as the Accountant Welfare Act.
So basically what you're going to have to do is you're going to have to figure out what your qualified business income, and this is pretty funny because it's not actually income, but it's a deduction. And catch this, it's the sum of the lesser of 20% of the taxpayer's qualified business income or the greater of 50% of the W-2 wages with respect to the business, or 25% of the wages with respect to the business, plus 2.5% of the unadjusted basis of all qualified property. So did you catch that? So, right? So basically, it means that you're going to have to come up with a calculation before to figure out what this qualified business income is. And once you go through the hoops to get there, then you can actually figure out what you're going to do with it. And the big thing is we don't know what we don't know yet. And this is where regs from the IRS are going to come into play. And this is where this case law is going to litigate this, and we really don't know what's happening here. But we do have kind of generalities. And so when I talk about this, I really want you to understand that this is really, super general, and we will figure out how it's all going to flow through in the future. So
And
next.
Jody, do they specify out of the wages, how much of it has to be the owner's wages versus just general wages? Or is that not specific? Is it requiring owners to have a certain dollar amount of wages, or is that not?
Yeah, so first of all, if you're an S corp, you should have reasonable comp anyways, but
Right.
we're going to have to redefine what reasonable compensation is, right? Because what could the reasonable comp do, and how could this change that calculation? And that's what we don't know, right? So that's kind of, to me, the fun stuff. But let's take it to the next slide. The other thing they said is not all businesses can take this deduction. And they said a specified service, trade, or business. So basically, if you're an accountant, if you're an attorney, if you're someone who actually provides services, you may not be eligible to take this deduction. And so again, this is all going to get litigated, I'm sure, because people are going to say, well, is this service? Is this not service, right? And so we're not exactly sure, but we'll find out soon enough if we're eligible for this QBI deduction. Next slide. So if you look at an example, and you're going to be able to get these slides if you want them, because I know this is pretty quick to go through, but basically in the example, if you have QBI of $200,000 from an S corp that paid a total of $30,000 in W-2 wages and has no property, and then there's a spouse income limitation, right? You go through the calculation, and you take the greater of. And if you look at the last line, well, normally A's deduction would be limited to $15,000 because A's taxable income is $270,000, which is less than $315,000, which is a very specific limitation. The two limitations are disregarded, and A simply takes a deduction equal to 20% of the QBI, or $40,000. So basically, you get $270,000 minus $40,000, and that's what you're taxed on. So this may seem very overwhelming, and I think it is to small business owners, but CPAs should be able to walk through this once they have final regs, right, to give you the right information. But the big thing is to realize this 199A is going to have a really good impact for small business owners. And the key highlights of it is if you're small business under 315, it doesn't, the regulations don't apply from a service perspective, so everybody's going to be eligible for that. And then the other piece is to know that you're just going to have to be able to navigate what you should be paying yourself in compensation so that you get the deduction. And Trump at the 9th hour put in the last piece, which says that it's 2.5% of your capital purchases. So this QBI limitation our deduction is going to apply to rental properties, which is huge, right? He gave us that opportunity so that real estate professionals will be eligible for this as well. And in the last couple slides of mine, which I really want to be reflective of time, it says basically that it gives a couple examples of how it could work. And I have to give a shout out to Tony Nitty, who I stole his examples right from his Forbes article, which he's an awesome tax professional. But it gives a couple examples of how different businesses are affected by this 199A deduction. So last couple slides. You can fast forward through that. And I think this is really important. We don't know what a definition of a trade business is actually, and we know that we're going to need lots of clarification on the regulations that revolve around these rules. And as I said at the beginning of the presentation, it could take us 3 to 5 years to kind of figure all of this out. So be patient with your tax preparers, be patient with the IRS, even though we don't like the IRS. Be patient with them, and I think overall this law is good for most small business owners. So let's just embrace it, and let's figure out how to work with it so that we can pay the least amount of tax that we're legally able to, because I think that's how you have to look at it, right? And if you'd like to contact me, feel free to send me an email to jody@newvisioncpagroup.com. I know myself and Hector went through a lot of information, and a lot of it's hard to understand if you're not fully versed in the tax law. So I know a lot of times we talk to things like we have the expectation that you understand what we're talking about. So hopefully I was pretty clear, but if it doesn't help, if you don't understand it, feel free to reach out with further questions or ask your tax professional, and that they can help you.
Again, Jody, thank you very much. Also, thank you for kind of shortening up the end, because I know you probably needed another 10 or 15 minutes to go deep into the pass-through entity 20%. But by the way, maybe I took that pressure off your back, because that's something that is still, I will tell you unequivocally, I would say 9 out of 10 tax practitioners I've spoken to, friends and colleagues, that is the one area that everybody's confused about. The 21% tax change to the corporations, easy, straightforward. This whole 20% to pass-through entities, that is limited by the income and the number and the amount of wages, that like when Jody put the example up, I got headaches because it looked like a CPA exam question. It's supposed to simplify the tax code, and I think for the most part, it's simplified. The double standard deduction for individuals, absolutely simple. That's a simplification of the tax code. This 20% of it is not a simplification, but is with the intent of helping small business owners. And that's the one promise that Republicans made and Trump made during the campaign. And I think effectively it will help tax-wise small business owners. And I would love to know, what are your thoughts? Is it confusing? Is there anything exciting about it? Do you not like the tax reform at all? I would love your feedback. Put it on the polling question. If you're watching this on YouTube, put it in the comments below. Let's continue the conversation on the subject matter. Again, I'll give you real quick the results so you see them. The vast majority of people are excited about small business reduction of taxes. So that's actually great. Again, Jody's email is jody@newvisioncpagroup.com. If you email her, she will send you a PDF of her slides. And I believe Jody was adding a couple of tweaks to the slides. I literally asked her to do this on January 3rd. She didn't even give the kids Christmas presents or anything. She spent she didn't even party for New Year's. She spent the entire December 21st to today preparing for this webinar. So thank you very much, Jody. I know it was a big undertaking. And also, Jody, just in case a small business owner that likes what you got to say is watching this, what is your ideal small business client? What are the type of clients that you'd like to work with this year?
So typically, the individuals we work with, we want our individuals to either have small businesses connected to them or need greater financial planning from a wealth management standpoint. And then our small business owners, we like to be proactive with our our small business owners and work with them throughout the year. We don't just do tax returns at year end, right? So our small business owners have to be willing and wanting to work with someone who can help them plan for their taxes all year long. We work in fixed price agreements, which means that we set a price up front. There's no surprises. They pay monthly, and there's no surprises. That's the big thing, because we want to be proactive with tax planning, because that's the only way you can plan, is to do it proactively. You can't do it at the end of the year when you're just trying to get a tax return done. You have to be able to make those changes in 2018 so that, for next tax season, which is when these will really hit us, we'll be ready and we'll be paying the least amount of taxes possible.
Yeah, I think that if you're shopping around for an accountant, you should work with someone like Jody that has that philosophy that says, hey, instead of just working post-mortem, right, working with all your paperwork on February, trying to get everything done by March, work throughout the year preemptively. A lot of folks want us to do magic and break the law sometimes and doing unethical things to lower the taxes. And most of us accountants, that's not what we do. We can't do that. We only get one chance to get our CPA license. All we can do is apply the law as it applies to them, everything post-mortem. But if we're working with an accountant throughout the year, asking those questions throughout the year, meeting with an accountant, I would say monthly, maybe probably too much, but at least quarterly, to make those estimated payments, to make the right entity choices. I think this will be the year of entity choices. I think entity choices are going to be humongous. I also think all the states are going to make a buttload of money this year with new corporations that are going to be created. A lot of folks are going to be creating C corps.
Right.
C corps are sexy again, right? S corps are still sexy, 20%. I mean, that's a lot, but I think C corps will be sexy again.
Yeah, and I work remotely with everybody, so no worries about where you're located. I'm actually in Chicago, but we work with everybody in all the states and even internationally as well.
Perfect, Jody. You can log out now. Thank you very much. Get back to work. You got to get work on those 1099s now. So thank you very much, Jody, for that. I put up a polling question real quick. I'd just like to know if you learned something new, if you were familiar with some of it. Love to know if we did a good job at least at bringing at least something new to the table to folks watching this live. And if you're watching the recording on YouTube, put in the comments below if you did learn something new, or if we made a mistake, call us out on it, please, because we're human. We disclaimed at the beginning, this is our opinion and our interpretation of it. This is not tax law. Like, don't record this video, take it to your IRS audit and say, follow what these people said on the video. Like, you gotta work with your tax professional on all that stuff. So I'll go ahead and close that polling question and wrap things up. So our next webinar will be exactly a month from now, first Wednesday from February 7th, and it's gonna be called Entity of Choice. I actually had a feeling that we were not gonna have a chance to go deep into the S Corp partnership 20%. So I'm gonna bring in another guest. I'm gonna give Jody a break. I'm gonna bring Chris Reagan from Halland Tax, from Tax Planner Pro software, to come in and talk to us about Entity of Choice, and then maybe dig a little bit deeper into that how the 20% structure works in. And I know Jody will be maybe adding more examples into her slides, so if you email her and get those slides on that. Then we'll be on break during most of tax season. Come back in May. I don't know what the topic will be. It'll depend on the area of expertise of the next person we bring in. Other webinars I'm involved in, we have a bi-weekly webinar series called QB Power Hour. And if you're a QuickBooks user, QuickBooks consultant, you know about this already. You probably already registered to it. It will be on Thursday, January 11th. I will go deep dive into QuickBooks Desktop Payroll and some of the end of the year payroll type of procedures in QuickBooks Desktop. And then I'm having a webinar on Friday, February 2nd at 1 p.m., which is our second installment of video marketing for accountants. And I will talk to you about the power of daily and weekly live videos. I'm actually starting to do daily live videos in my Facebook, personal page, and I'm gonna tell you 30 days later what impact has that had on my business, on my friends and family, on new critics, on new fans. Who knows? I'll discuss that in detail. in my experience with doing daily, in my case, daily videos. I think most folks should start with weekly. Daily's a lot, but I'm a little bit overzealous and I want to share a lot. So I'm doing daily videos. To register for that webinar, go to my website, hectorgarcia.com/video. And lastly, stay connected. Find us on the Facebook group. Continue the conversation there. If you're a small business owner, you're going to get a lot of free tax advice because everybody in that group wants to be the first one to answer because we're all smart Alex. And if you're another tax professional, another accounting professional, let's share with each other what we think about this tax law. Let's help each other determine and understand what the heck is going on in 2018 with the new tax law to better our profession and our businesses. My email is hector@garciacpa.com. Thank you very much. You have a wonderful day. Thank you, Jody. Happy New Year.